A British expat can live outside the UK for many years, build assets internationally, and still remain fully exposed to the UK inheritance tax. Your estate can still be treated as connected to the UK, and the UK inheritance tax may continue to apply to your global assets at the time of death. This creates a structural mismatch. Your wealth becomes international, but your estate exposure remains tied to the UK rules. The practical consequence is that your beneficiaries may face a tax charge of up to 40% on global assets, combined with probate delays, multi-jurisdictional administration, and potential liquidity pressure. My name is Shiraz Wahid, and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how the UK inheritance tax works for British expats, when it still applies after you leave the UK, and how proper planning and structures like trust and foundations can be used to minimize the inheritance tax exposure while maintaining control, governance, and continuity across generations. Many British expats assume that once they leave the UK and become tax resident elsewhere, the UK inheritance tax no longer applies. This assumption often is incorrect. The UK have moved towards a residency-based approach. This means that your exposure depends on how long you were UK resident, not just where you live today. Under the new framework, individuals who remained UK resident for around 10 years out of the previous 20 tax years can remain exposed to the UK inheritance tax on worldwide assets. This exposure can continue for a period even after leaving the UK. As a result, simply moving abroad does not automatically remove inheritance tax exposure. This is where many British expats misunderstand their position. They start with relocating abroad and then build assets internationally, and then assume that their estate is now outside of the UK tax net. However, if they fall within the residence look-back period, their global estate may still be considered when inheritance tax is assessed. This means investment portfolios, international property, business holdings, and other non-UK assets may still be exposed. The planning objective therefore becomes reducing what sits inside the taxable estate rather than assuming relocation alone solves the issue. The inheritance tax rate in the UK can reach up to 40% above available allowances. Currently, individuals typically have a £325,000 nil rate band, and in some cases, an additional residence nil rate band may apply. But internationally diversified families often exceed these thresholds very quickly. A combination of property, investment portfolios, and business interests can create a large taxable estate. The tax rate is only one part of the problem. Inheritance tax is generally assessed before assets are fully transferred to beneficiaries. This means liquidity may be required inside the estate. If wealth is held in illiquid assets, executor may need to sell investments or dispose of property to fund the liability. This can lead to forced decisions. A long-term investment portfolio may be reduced. A property may be sold earlier than intended, or shares in private businesses may be transferred under pressure. These outcomes are driven by tax timing rather than family strategy. For expats with assets across jurisdictions, these complexities increase even further. Different countries may require separate probate processes. Financial institutions may freeze accounts until documentation is complete. During this period, inheritance tax exposure remains in place while access to assets may be restricted. This is why the objective of planning is not only administrative. The objective is to reduce the taxable estate itself. When assets are held in your personal name, they typically form part of your estate. This means they are exposed to inheritance tax and subject to probate. In cross-border situations, probate can become fragmented and slow. Executors may need to deal with the UK probate, foreign legal processes, brokerage requirements, and corporate documentation. Each institution may require separate authority before assets can be moved. During this time, the control of the estate is limited. This matters because inheritance tax is assessed on the estate value, not on what beneficiaries actually receive. If estate is large and assets are held personally, the entire value may be exposed. This is where planning begins to change the outcome. Instead of holding assets personally, ownership can be structured so that certain assets sit outside the personal estate. When assets are not part of personal estate, they may not be subject to UK inheritance tax, depending on the domicile, timing, and legal design. There are several recognized approaches used by British expats to reduce inheritance tax exposure, and these are usually implemented together rather than in isolation. One approach is managing your residency timelines and long-term exposure period. If a British expat successfully establishes a new domicile outside the UK and sufficient time passes, exposure to UK inheritance tax on non-UK assets may be reduced. This is not automatic and depends on facts and your intent, but it is a key planning consideration. Another approach is lifetime gifting. Under the UK rules, gifts made during a lifetime can fall outside the estate if you survive for 7 years after making the gift. This is often referred to as the 7-year rule. If death occurs before 7 years, part or all of the gift still may be brought back into the estate. This means that timing matters. Larger estates often begin gifting early, gradually transferring assets such as investment portfolios, company shares, or cash into the next generation or into long-term structures. However, gifting must be done carefully. If you continue to benefit from the gifted assets, for example, continuing to use property or draw income without proper structuring, the asset may still be treated as part of your estate. This is why gifts are often combined with structured ownership rather than simply transferring directly to the individuals. Another approach involves placing assets into structures such as trust or foundations. These are commonly established in jurisdictions such as the UAE, Cayman, or Liechtenstein, where governance frameworks allow separation between personal ownership and structured ownership. When implemented correctly, and depending on the timing and residence exposure, assets held inside these structures can sit outside of your personal estate. This can significantly reduce the value exposed to inheritance tax. For example, investment portfolios, private company shares, or holding companies may be owned by a foundation or a trust rather than you personally. Succession then takes place within the structure rather than through your estate. Over time, this can reduce inheritance tax exposure while maintaining control through governance roles. Insurance planning is another layer. Instead of reducing the taxable estate, insurance is used to create liquidity. A life insurance policy written within the estate can provide funds to settle inheritance tax when it arises. This avoids forced sale of property, business interests, or long-term investment portfolios. For large estates, this is often used alongside structural planning. Now, for larger portfolios, another approach sometimes used is an insurance wrapper. In simple terms, this places an investment portfolio inside a life insurance policy, typically owned by a trust or a foundation rather than by you personally. This means that the underlying investment are not held in your personal estate, while the portfolio continues to be professionally managed. When structured correctly, the policy proceeds pass according to the trust or foundation terms rather than through probate. In practice, these strategies are usually layered together. Lifetime gifting gradually reduces the size of the estate, while trust and foundations move certain assets outside of personal ownership. Insurance is then used to create liquidity so inheritance tax can be paid without selling long-term investments. And for larger portfolios, an insurance wrapper can sit alongside these structures to hold investments in a more efficient ownership format. Together, the objective is to progressively reduce the value exposed to the UK inheritance tax while maintaining long-term control and continuity. When structured ownership is used, the intention is to separate certain assets from the personal estate. Instead of assets being owned personally, they may be owned by a structure designed for succession planning. These structures often take the form of family foundations or trust established in jurisdictions like Cayman, Dubai, or Liechtenstein, as well as Seychelles. The legal framework in these jurisdictions allow long-term ownership independent of an individual. If implemented correctly and depending on the residency, exposure, and timing, assets held within these structures may not form part of personal estate, and this can help reduce the value subject to UK inheritance tax. Investment portfolios, holding companies, and international assets can sit inside the foundation or trust rather than in your personal name. However, this does not happen automatically. Authorities examine control, benefit, and timing. If the structure is created late, if assets are not generally transferred, or if effective control remains unchanged, the tax outcome may not change. This is why planning must be implemented carefully and well in advance. When structured properly, however, this approach can significantly reduce estate exposure. Ownership sits at the structure level, while governance rules defines how assets are managed and how benefits pass to future generations. Succession then occurs within the structure rather than through the estate. This reduces both tax exposure and administrative friction. Ownership continues without interruption, control transitions according to governance rules, and fewer assets remain inside the personal estate subject to UK inheritance tax. Even when gifting and structured ownership are used, some families still want want greater certainty over how inheritance tax will be funded. This is where insurance wrappers are often introduced as an additional layer within the overall plan. An insurance wrapper typically holds an investment portfolio inside a life insurance policy, and that policy is owned by a trust or foundation rather than by you personally. Because the policy is not owned in your personal name, the value can sit outside your estate depending on how it is structured and when it is implemented. This creates a clearer separation between personal ownership and structured ownership. Unlike gifting, which depends on surviving a period of time, an insurance wrapper can create a more immediate planning certainty. The ownership is defined from the start, and the policy benefit pass according to trust or foundation terms rather than through probate. This allows assets to transfer in a controlled way without relying on estate administration. Another advantage of insurance policy is liquidity. When inheritance tax arises, the policy can provide funds without requiring the sale of long-term investments. This avoids forced liquidation of portfolios, private business interest, or property. The underlying investments can continue to be managed within the wrapper while the policy provides a defined succession mechanism. For larger estates, insurance wrappers are often combined with foundations or trusts in jurisdictions such as Cayman, Dubai, or Liechtenstein. The structure owns the policy and the policy holds investments. This creates a layered approach where ownership and succession as well as liquidity are addressed together. This does not automatically remove inheritance tax in every situation, and residence, exposure, and timing still matter. However, when implemented correctly, insurance wrappers can add a level of certainty to the planning. The ownership is defined, succession is predetermined, and liquidity is available when needed. Inheritance tax planning is highly sensitive to timing. Structures created shortly before death or without genuine planning intent may not achieve the desired results. Authorities often examine when assets were transferred, who controls them, and who benefits from them. This is why it's recommended to implement these strategies well in advance. The earlier the structure is created, the more likely it functions as intended. Governance is established, ownership is transferred, control is defined, and over time, the estate exposure may be reduced. Coordination between jurisdictions also matter. UK residence exposure rules must be considered. Local tax rules must be reviewed, and financial institutions must accept ownership structure. Legal documentation also must align. When these elements are coordinated, the result is a smaller taxable estate, improved succession planning, and reduced pressure on beneficiaries. The objective is to minimize the inheritance tax impact as much as possible within the given rules. So if you would like our help and want to understand and explore if these structures fits into your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.